While the Bank of Canada may have raised interest rates by 0.75%, that doesn't necessarily mean that fixed rates have gone up. In fact, they've remained relatively flat even in the face of higher Bank of Canada rates. And I'm going to explain why and tell you exactly what the rates are for variable and fixed for both normal mortgages and discount mortgages after the intro.
The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right.
All right, so welcome back. Obviously, the big news in the interest rate world has been that the Bank of Canada increased interest rates by 0.75% in the last couple of weeks here, as did the Federal Reserve on Wednesday in the US. But many may be surprised to know that 5-year fixed rates have not increased. And the reason why is because bond market yields haven't increased, and therefore the pricing has remained fairly similar for those 5-year fixed mortgages. So those that were rushing to lock in before the interest rate hikes, well, they probably didn't need to, because the bond market is what dictates the 5-year fixed rates, not necessarily what happens with the Bank of Canada. Now, obviously, the bond market has some expectations about what will happen to interest rates in the market, but those usually play out well before a Bank of Canada interest rate hike. Now, before we get into all the details of what interest rates are this month, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And if you are in the market for a mortgage, don't forget about our Secrets to Getting the Lowest Interest Rate course that will guide you through how to getting the absolute best rate on the best mortgage for you. You can get that at ratesecrets.ca. Okay, so let's jump into the rates for September of 2022. So this is again where it gets interesting. We're going to start first and foremost with insured variable rates. Now, as most of you know, the insured variable rates that we deal with are pretty much all adjustable rate mortgages, so they have adjustable payments. These are, in my opinion, the safest mortgages for Canadians because the payments change as interest rates change, meaning that you aren't having a false sense of security for 3 or 5 years, only to get hit with a hammer on renewal and find out that your payments are going to go up substantially. So the insured, or in other words, less than 20% down, variable adjustable payment mortgage rates as of today for a full featured mortgage, this means they have all the benefits, all the features, no restrictions, is 4.55% or prime minus 0.9. Now, if you're putting 20 to 35% down, the rate at 35% down or better is also prime minus 0.9%. And if you're putting 20% down, it goes to prime minus 0.55. The reason why is because the 20% down mortgages no longer have insurance on them, and they represent the riskiest mortgages for the lenders because they're the ones where the lenders have the most exposure. Now, moving on to the 5-year fixed counterpart, and this is where it gets interesting again because these rates have actually come down since June. An insured mortgage on a 5-year fixed is at 4.59%. And if you're putting between 20 and 35% down, you're looking at between 4.59% and 4.84%, obviously with the higher range of those payments being at the lower down payment amounts. So moving on to discount mortgages, these are the ones that have some sort of restriction or some sort of drawback associated with them. You pay a lower price and you get a lesser product. That's just the way everything in life works. If you buy a cheaper car, you're going to get less features than if you buy a more expensive car. And in today's market, a 5-year fixed mortgage that is discounted is right around 4.39% for a 5-year fixed and about 4.3% for a 5-year variable. Now, moving into the uninsured discount mortgages, you're again looking at that 4.39% rate if you're putting 35% down on a 5-year fixed, and you're looking at about 4.64 if you're at that 20% down payment range. And when you get into the variable discount rate mortgages, you're looking at about 4.3 to 4.65%, depending on how much down payment you're putting down. Again, as soon as you get to 35% down, you start getting the absolute best pricing like you have with insured mortgages. But between that 20 and 35% down payment amount, you start to pay a little bit more because, again, those mortgages are more risky. Now, the arguments for variable versus fixed haven't changed. With fixed rate mortgages, you still risk a penalty at some point if interest rates do start to go down. And with many economists predicting that we're going to face a recession at some point in the near future here, I think it is a safe bet that at some point, maybe not in the immediate future, but somewhere down the road, there are going to be opportunities to get lower interest rates. The Bank of Montreal just suggested that there's a 99.9% chance that the Bank of Canada and the US Federal Reserve is going to push the economy into a recession. And with basically 100% odds, that means that at some point, those interest rates are going to take a turn and come down at least a little bit. So we're still wary for the exact same reasons of the 5-year fixed mortgages that we were previously. I'll link to videos up here in order to talk a little bit more about that. And if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video, and we'll see you on the very next one. Cheers.